Right, Lewis, I think we can go ahead and get started. We are going to record this for anyone else who ends up joining.
Thank you, Stephanie. Good morning, everybody. We're excited to be here this morning with you. My name's Louis Memelo. I'm one of the partners at Weiner Benefits Group, along with Mike Reckner. And you can see that wonderful picture of us on the screen there. But this is the third part in our series of alternative funding concepts. And today's concept is on medical captive insurance programs. But before we get started, a little background on Weiner Benefits Group, in case you don't know who we are. We're in our third generation. We have hundreds of group employee benefit clients like you, and have had those clients like you guys for multiple generations, 3 generations, in fact. And we've maintained this through long-lasting relationships with our clients, based on the fact that we help you achieve a sense of security and peace of mind. And that's for you as employers, but also your employees. And we help develop those programs that provide that. And we do that through a process we call providing innovative solutions and a sense of a holistic view of financial well-being from hire to retire. And we use all of the things you might expect, your employee benefits, health and welfare, medical, dental, life, disability, strategic planning, HR services, enrollment services, compliance services, non-qualified executive benefits. So from the date of hire for every level of employee you have all the way through, including retirement, so qualified retirement plans, 401k, 403b, and so on. And all of the services that encompass those programs as well. A holistic approach in financial well-being and education, participant engagement, plan design, fiduciary oversight. And then as people transition from employment into retirement using these tools, Medicare, income planning, and then individual wealth management as folks go off into their next phase of life in retirement. So from hire to retire, we provide everything that you might need or want as an employer to attract and retain the top talent that you need for your business. And then in order to do that, we have a great team, and several of our team members are on the call today, and we have account executives dedicated for benefits and retirement plans. And you see Denise and Stephanie and Wendy. We have associate advisors and account managers that support the benefits teams and the retirement plans. And we have claims and service, Adele and Laura, and we have interpretation and language services with Lacey and others. So a full team to help you get your plans started, and managed, administered, and successful across the board. So we're excited, and we're here to serve you at whatever level, so just let us know. And this is, as I said, this is part 3 of our webinar series on alternative funding strategies. Started with ICRAs, and then self-funding and level funding, and today is captives, and then we have consortiums as another flavor, so to speak, of partial self-funding coming in July. All of these are recorded, as is today's webinar, and you can hit the link or look at the link or find weinerbenefitsgroup.com, and right at the top of the page, you can click that and you can get these recordings for future reference, because there's a lot of great information. Like today, we have as captive programs, and in general, the impetus of all of this is because, as you know, healthcare costs continue to rise, and many employers are searching for new ways to deal with the rising costs, to bend the curve on utilization in a way that helps the employees but controls costs. So all self-funded type programs could be an effective strategy, and that's what all of these encompass, are alternative methods of funding your plan. And a captive, in general, and I'm not going to steal the thunder from our speaker today, but in general, it's an independent insurance company that's created that provides insurance to and is controlled by its owners. It's created and owned by at least one non-insurance company for the purpose of ensuring the employee benefits risk of its owners and their employees. So it's a very interesting and very customizable approach that has a lot of benefits. Better coverage terms often, better cost structures, more transparency, more tools to bend the curve, more analysis, all kinds of great things that help along the way. So I'm not going to take up any more oxygen or time here, and we're going to switch our slideshow here and introduce our speaker. Our speaker is Scott Van Alst, who is an associate vice president of business development at Captive Resources. He has 20 years plus in benefits consulting. He's responsible for the broker channel development and captive program education in the Northeast region. And Captive Resources has 40 years of experience in the captive marketplace, with over 45 different group captives that encompass over 6,500 member employer groups like yourselves in those 45 different captives. So they're one of the largest captive consulting groups available, and that's why we wanted to bring them to represent this idea to us. So at this point, Scott, without further ado, go ahead and take over. Thank you.
Before Scott gets started, I just want to let everyone know I am monitoring the chat and Q&A, so please feel free to put your questions in there. We can stop along the way if we're getting a lot of questions on one specific topic that Scott is on. Otherwise, at the end, we will definitely review the questions.
Sounds good. Thanks, Stephanie. Thanks, Lewis, for the introduction, and good morning, everybody. Again, my name is Scott Van Alst with Captive Resources. As Lewis mentioned, I've been in the industry now for a little over 20 years. Captive Resources has been an independent consultant to group captives for 40 years. And as Lewis mentioned, we have 45 group captives that we support today, some of which are on the property and casualty side, and some of which are on the medical stop loss side of things. So our focus today is going to be related to the medical stop loss captives. And as Lewis mentioned, I think everyone on this call is well aware of some of the heartburn that health insurance continues to cause relative to increasing costs, specialty drug utilization, in a lot of cases, lack of transparency or control. And so today we're going to talk a little bit more about how the group captives help to support different outcomes relative to total healthcare spend, but also how it drives more control and transparency for your organizations and, quite frankly, for your employees to drive a much different outcome on total healthcare spend, but in most cases, a different experience for your employees as well relative to their healthcare plan. To level set a little bit to Lewis's comments, if you think about insurance in general, we've all had some experience with purchasing an insurance policy, right? Whether that's car insurance, whether that's life insurance, whether that's group health insurance. And we pay a premium for that, right? To insure the risk. In years in which we don't actually utilize the insurance, I think we're all familiar with the fact that we never get that phone call or email from the insurance carrier saying, hey, thanks for a great year. Thanks for paying your premium. We didn't have any claims this year, so we're going to give you a percentage of your premiums back, right? That doesn't happen in today's world. In fact, you might see a little bit of an increase in your insurance premiums, even in good years. And certainly when you have a challenging year, you're going to see larger increases to that premium. So essentially what we're going to be talking about today is you all as organizations transitioning into an environment where, as Lewis mentioned, you're becoming an owner of a reinsurance company, right? And that's going to give you more control and more transparency, but it also gives you the opportunity to leverage underwriting profits, right? So in years in which you perform well, you're going to get premium dollars back, and the captive is also going to insulate you from the volatility that might occur on a year-to-year basis, right? Some years might be more challenging than others, But at the end of the day, the goal is to keep your fixed cost stable and more predictable, and leverage the risk management tools and resources that the captive and the Weiner benefits team is supporting for you, again, to impact your cost curve long term, in this case, relative to your healthcare spend. So hopefully that level set a little bit. Lewis did a great job of introducing captive resources. I won't spend too much time here, and I'll move through things pretty quickly. From an agenda perspective, we're going to talk a little bit about captive resources here and our background. We'll get into group captives in general, and why group captives might be a good solution to address some of your healthcare cost challenges. For those of you who are not as familiar with self-funding, there's some terminology and concepts relative to self-funding that we'll cover. And then we'll get into what a captive actually is, why it's something that you might want to consider. We'll talk you through how the captive actually works. And then we'll kind of summarize some key takeaways and clarify, what type of employer groups are good fits for group captives in general. And hopefully we'll have some time left to have some Q&A. And I think, in general, if we can get 1 or 2 or 3 takeaways for you today that you can go back to your teams with, and you can discuss a little bit further with, maybe it's even a follow-up with the Weiner team to, navigate or dive in a little bit deeper into how this captive solution might work for you. That's a positive outcome, right? So without further ado, captive resources, as we mentioned, has been around for 40 years. We have 45 group captive programs that we consult for today, $4 billion in premiums under management. And if you think about the size of our organization, we're roughly about 400 employees. And if you think about ancillary carriers and the number of employees that they utilize to support $4 billion in premiums, it's somewhere around 3,000 to 4,000 employees, right? So just to give you some idea of our scale in the industry, we are the largest captive consultant in the country. And as a result of that, when we talked about becoming an owner of a reinsurance company, there are some capitalization costs associated with joining a group captive, and that's pretty common in the industry. Our capitalization cost and what we do with those dollars is a little bit different than most. We've created a captive investors fund that has $8 billion in assets. So again, as you become an owner of a reinsurance company, you've got dollars that are potentially coming back to you via underwriting profit. But there's also an investment component that drives investment income back to you as an organization as well. And we'll talk a little bit about that in a little bit. So to kind of dive a little bit deeper into what the problem is relative to healthcare, and some of you are well educated on this, but as Lewis mentioned on the front end, right, cost of healthcare continues to rise. In fact, it's tripled over the last couple of decades. And a lot of employer groups, just like you, are saying, hey, we can't continue to push anything more onto our employees in terms of the cost share. We as an organization, quite frankly, can't continue to take on these increases. And so what else is out there that could potentially help us gain more control over our healthcare spend, get more transparency, and really stabilize and become more predictable on our healthcare spend year to year, right? The other thing that's a driving factor here with frustration on group health benefits is the fact that when you think about recruitment and retention of top talent, benefits, as you all know, is right up there in terms of the importance for an employee considering staying with an employer or potentially leaving to take another opportunity somewhere else. The pandemic has magnified that a little bit too, right? A lot of opportunities out there. Benefits outside of pay is likely the #1 driver of why I might choose to go to employer A versus employer B. And then one of the other drivers of this healthcare cost increase is pharmacy, right? Specialty drugs. When you look at this slide, it tells a pretty significant story here around cost of specialty drugs. Today, pharmacy cost probably represents somewhere in the neighborhood of 40 to 50% of your overall spend. And the FDA continues to approve these specialty drugs more frequently than they ever have before. And the cost of those drugs is north of $150,000 a year, right? So if you look at this median annual price for FDA approved specialty drugs, it increased from $180,000 in 2021 to $220,000 in 2022. That's a 22% increase in specialty drug cost, right? So whether I'm fully insured or if I'm level funded, or maybe I'm self-funded today, specialty drug cost is impacting your cost of healthcare, right? How it comes to you is a little bit different, right? But we'll talk a little bit more about that throughout the presentation today. And then for those of you who are fully insured today, there's a common theme here, right? Increasing cost of care is a challenge, right? It's hurting your bottom line. You can't push anything more onto the employees, as I mentioned. In a lot of cases, there's a lack of transparency, right? You purchase an insurance policy, there's a price point attached to it. You have no visibility into how that plan is being utilized by your employees. But at the end of the year, you get a renewal notice and it could go up 10, 15, 20, 30% or more in some cases. And you don't really have a clear explanation of why, right? Or what cost drivers are driving that increase and what levers could we potentially pull to actually impact those cost drivers, right? And reduce our spend. And that's why transitioning into self-funding is benefiting employer groups, because they do get that control, they do get that transparency, and they do have the ability to pull different levers once we identify where the areas of opportunity are relative to those risk management opportunities. And at the end of the day, right, who's profiting? It's the insurance carrier, right? We talked about this on the front end. We purchase an insurance policy, we pay a premium. If we run well, who profits? It's the insurance carrier, right? And then in years in which we don't perform so well, that's great that we've got the insurance, but guess what happens at renewal? We get a significant increase and now we're paying more for our premium on an annual basis, right? And obviously a lot of employer groups that are in that mid-market space, let's say 50 to 500 lives, they might be scratching their head a little bit saying, well, is self-funding really something that we can do, right? Do we have the cash flow? Do we want the risk or responsibility? How much more can we take on administratively? What does that look like? And at the end of the day, because of all of the challenges that we just outlined, we've seen a pretty significant increase. The market has seen a pretty significant increase in mid-market employer groups transitioning to self-funding. In that 50 to 1,000 space, there's been a pretty significant uptick amongst those mid-market employers transitioning to self-funding. One of the reasons why is because group captives are not only allowing the control and the transparency for those employers, but it's also insulating those employers from large claim risk and accumulation of claim risk over the course of a policy period. So they can self-fund and have some peace of mind that they have some insulation from large claim exposures and accumulation of claims in a given year, especially when they're coming from a fully insured environment without any real visibility into what their claims utilization looks like. Okay. So a couple self-funding concepts and terms. We talked about insurance carriers, right? I'm purchasing an insurance policy. Well, the reality is those insurance carriers, right? The Aetnas of the world, the Cignas of the world, United Healthcare, Blue Cross Blue Shield, they were created and identified a network. And they went to doctors and facilities and providers and said, hey, we're willing to pay X amount of dollars for these services. And those facilities and providers said, okay, instead of us charging $500 for that office visit, we'll only charge $250 for you. And instead of that $2,000 MRI cost, the cost on your network, it'll only be $1,000, right? So they're essentially acting as a conduit towards accessing coverage and negotiating a fee schedule to technically make the insurance more affordable for you. So they're acting as a third-party administrator, right? They're adjudicating claims, they're giving your employees access to a network and a negotiated fee schedule. In a self-funded environment, we're also going to leverage that third-party claims administrator who's going to give you access to a particular network. In a lot of cases, it could be the same network you have today. We're also going to have the flexibility of carving out your pharmacy benefit component. So there are things in the market today like RX rebates. There are manufacturing assistance programs. There's international sourcing of specialty drugs that allow for those drugs to be sourced at a much different cost or price point. So what we're doing here is leveraging third-party administrators to give you access to networks that you're very familiar with today and that your employees would be very familiar with. But we're giving you more control to dictate how you design your plans, what you do relative to supporting or sourcing your pharmacy benefits, and then obviously, plan designs and network access is flexible as well. So now that we've got kind of the arms around what the plan could look like, what the network could be, how we're going to support the program on a self-funded platform, these terms that you see on the screen here are really related to what the plan sponsor is doing in a self-funded environment to limit their risk or their exposure. They're going to purchase, or you're going to purchase, stop loss via the captive to protect yourself against large claim exposures and accumulation of claims over the course of a policy period. So specific stop loss is going to protect you on a per person per year basis for any type of large claim exposure that exists. So your responsibility will be capped at a specific deductible level. Aggregate stop loss is going to be put in place to protect you against the accumulation or the frequency of claims that occur within a policy period. So at the end of the day, you have protection against large claims, and you also have protection against accumulation of claims up to a certain point, which is called the aggregate attachment point. And once I get to that aggregate attachment point, right, my exposure is capped. Everything else at that point would be supported by that aggregate policy. So for those of you who are fully insured, this is an example of what you're doing today. You're choosing an insurance carrier. You're choosing a network, right? United Healthcare, Blue Cross Blue Shield, Aetna, Cigna, and you're identifying a plan design. And then you're paying an insurance premium and transferring all the risk to the insurance company. And depending on your performance or what that carrier decides to do at renewal, your rates are subject to increase every year, and you're kind of handcuffed to whatever that fully insured carrier decides to do, right? If I'm self-funding, I still get to choose my network, right? I still get to have a plan design that could look and feel very similar to what you have today, or maybe you want to tweak it and adjust some things that maybe aligns better for you and your employees. But instead of transferring the risk to the insurance carrier out of the gate, you all, as the employer, would take on a self-retention or a specific deductible amount, right? And that would be per person per year. And once that deductible amount is exhausted, then stop loss would step in and pick up losses up to unlimited. So for example, if you had a $50,000 specific deductible responsibility and you had a $100,000 claimant, your responsibility would be the $50,000. And then anything above that $50,000 would be supported by the stop loss carrier. That's traditional self-funding. Any questions so far before we get into the captive structure and what a captive is.
I do not have any questions in the chat or the Q&A box at this point.
Okay. So we'll get started and jump into this, and hopefully that'll leave us some time for some Q&A at the end. So we talked about this on the front end. What is a captive? Lewis kind of framed it perfectly. It's an insurance company that provides insurance to and is controlled by its owners. So we're going to bring this up again. Instead of purchasing an insurance policy, right, you're becoming an owner of a reinsurance company, and that control, that transparency is what gives you the opportunity to put your benefits plan together a little bit differently than what it is today, but also benefit from underwriting profits in good years. And when you have a challenging year, benefit from the captive protection, the insulation that the captive provides relative to large claims or accumulation of claims in a particular policy period. The captive is a long-term strategy, right? For some of you who might be fully insured and maybe every couple of years bounce from one carrier to the next because acquisition pricing reduces some of your renewal exposure, we're going to take you out of that hamster wheel, right? We're going to put you into a vehicle where you now have control and transparency. And instead of managing fixed cost scenarios, you're now focused on the larger variable spend and the opportunity to leverage risk management and advocacy tools to impact total spend. So the captive, at least from a captive resources perspective, is an offshore captive, right? We're domiciled in Grand Cayman. So when we started the company 40 years ago, the US regulatory challenges were real. They weren't as friendly to group captives. And so that's why today, 98% of group captives are domiciled offshore, either in Grand Cayman or in Bermuda. Kensington Management is the captive manager that is domiciled in Grand Cayman. Kensington is actually a sister company of Captive Resources, and they handle all the financial logistics of the captive. The reason we're domiciled in Grand Cayman is simply because, again, when we started the company 40 years ago, it was just ease of doing business. It's been really successful over that 40 years. All the world's largest financial firms and audit firms are located in Grand Cayman. So it really does make for a pretty seamless management team and has worked well over the last 40 years. We talked about the fact that this is a member-owned and controlled group captive. So when I refer to members, I'm actually talking about employer groups. So employer groups decide to become a member of a reinsurance company. They're going to actually purchase 2 shares of stock, a preferred share, which is how underwriting profits and investment income are returned back to the company, and then a common share, which is your voting right within the captive. Okay. The captive is going to reinsure each captive member up to a certain threshold. And then we talked about underwriting profits being eligible to be returned back to members on a year-to-year basis. So why group captives? We've already hit on a lot of this today, but it's about controlling total healthcare spend. It's about gaining back control over your insurance destiny, right? Stabilization of cost, reducing the volatility of the traditional insurance market, where one year you've got increases, the next year it's not as bad, but then depending on the insurance carrier and your utilization, you could have another spike in the following year, right? It's just unpredictable and really creates some challenges from an accounting or finance perspective relative to managing that cost. Data analytics, right? We talked about control and transparency. Transparency in a couple of forms. One is claims data, right? Getting access to claims data to understand where the areas of opportunity are. Is it pharmacy driven? Is it disease management driven? What can we do as an organization to not only impact our cost drivers, but also provide a different outcome for our employees relative to their experience with the health plan? And the captive, along with the Weiner Benefits Group, are identifying health risk management, cost containment tools and solutions and resources that give you access to impact those cost drivers, right? So what do the data analytics tell us? and what point solutions or strategies can impact that cost. The collaboration with like-minded businesses is a big part of this. We have annual meetings, we have workshops every year, and the members come together to collaborate. It's pretty powerful when you can fly into Chicago for a health risk management workshop, sit down next to a member who is facing or has faced some of the same challenges that you're facing relative to claims and cost, and they can share with you that they had the same problem and they implemented a solution that reduced that cost and provided a better experience for their employees. And now you can take that back, and Lewis and the Weiner Benefits Group team can help to support the implementation of those type of programs. So I know that sounds a little wonky, collaboration with like-minded businesses, right? What does that actually mean? But it is pretty powerful. And a lot of our members provide feedback to us that out of everything, that's the most valuable component of their tenure in our captive programs. We talked about underwriting profits previously, but again, that's something that is definitely a big part of why the group captive concept is intriguing to a lot of employers, especially those who are running well. This is a quick example of what we mean when we talk about strategic cost containment and preferred vendors, right? That can be a mouthful, and you might be saying, well, what the heck does that all mean? These are really the 6 pillars that the captive is focused on relative to risk management on the healthcare side. Pharmacy is such a big part of it today. You think about wellness and well-being, right? Mental health, preventative care. Those are things that certainly over time can have a pretty big impact to your employees and to your overall plan. Condition management, right? These are the areas of opportunity from a disease management perspective that I referred to earlier. Cancer, MSK, diabetes, things that are driving cost and that can honestly lead to larger claim exposures. We can start to address them on the front end. Network and steerage strategies, right? Centers of excellence, a lot of plan management opportunity, payment integrity, making sure that claims are filed correctly, no one's double dipping, etc. And then the member experience, right? Navigation and advocacy. When I do get diagnosed with something, or I'm prescribed a specialty drug, or I have to have a specific treatment or go through some type of prior authorization, who's supporting those conversations and those employee experiences? At the end of the day, it's going to be a joint effort. But these are the areas of opportunity that we're focused on and that Lewis and team are focused on from a strategy perspective. We talked about reducing volatility and gaining control. This slide is really a visual of what that actually looks like. Traditional market, it doesn't matter if I'm fully insured, level funded, or self-funded. This is what the traditional market looks like. And I know you've all experienced it. What we're trying to accomplish on the group captive side of things is to stabilize that, right? And to impact your cost drivers in a way that allow for a more stable year-to-year cost relative to your healthcare spend. We're leveraging scale to do that, right? Group purchasing of stop loss, your fixed cost. We're also leveraging the captive as a shock absorber. So even in years which you might have a large claim exposure, the stop loss carrier is not reimbursing for those claims because the captive is insulating you as an employer. And we'll get to that structure in a little bit. And then I talked about this before, and I'll hit you over the head with it again. The collaboration of like-minded businesses is such a big part of the program in general. A lot of best practices, a lot of experience. You don't have to feel like you're on an island on your own in this self-funded environment without any resources or tools or people to lean on, so to speak. You have the collaboration of other members to help you along the way. And the end result here is bending the cost curve, right? If you think about things nationally and take national trend averages and you just play that out over a 10-year period, whether you're fully insured, level funded, or self-funded, you're trending at a much different pace than what self-funded captive members are trending as. And so you can see this blue line at the bottom is how the self-funded captive members are trending relative to their healthcare spend. How could that be? All the reasons that I just talked about, right? Gaining the control, getting the transparency, leveraging risk management tools and resources, leveraging the group purchasing power of the captive relative to fixed cost, and then also leveraging the captive to insulate against those exposures in years which proved to be challenging, which again is driving a much different cost curve in the self-funded captive environment. So how does the captive work? Well, we looked at kind of the traditional self-funded environment on a previous slide. So to reiterate, we're allowing you to pick plan designs that either mirror what you'd have today or can be tweaked to whatever makes the most sense for you. If you want to reduce your deductible by $500, you want to change your copay by $10, you can certainly do that. On a per person, per year basis, you all are taking on a self-retention or a specific deductible. The deductible ranges can be anywhere between $25,000 and $500,000. And if you ever had a scenario where the stop loss carrier had to step in, they will cover losses above that spec deductible up to unlimited. Again, going back to my initial comment on the front end of our presentation, the insurance carriers in the traditional market are going to retain profits in good years. And when years are not so good, they're going to pass on those costs to you at your renewal. So how does that differ in a captive environment? Well, this is what the captive structure looks like. We're going to allow you to keep your plan designs and your network choices as you see fit. You're still going to select a specific deductible that aligns with your risk tolerance. And there's still going to be a stop loss carrier supporting claims above your specific deductible. The difference is we're going to take a portion of your stop loss premium and we're going to allocate it to a captive layer or a captive retention layer. And that retention layer will differ depending on the program that we align you with. But those dollars typically represent about 60% of your stop loss premium, which is allocated to this captive layer. And those dollars are going to be used to support claims. If it's a pooled captive, which we'll clarify in a little bit, those dollars are eligible to be utilized by any member in the program. And at the end of the year, if all the contributions from all the members and all the utilization that occurs in this captive layer leaves dollars at the end of the year, those dollars are then distributed back on a pro rata basis to all the members. In our risk reward program, which we'll talk about here in a little bit as well, instead of the dollars being allocated to the captive layer for everyone to access, we're allocating those dollars to your own individual loss fund. And that loss fund is going to support your large claim activity. But again, if those dollars are remaining at the end of the year, those dollars are eligible to come back to you. So you have control over your underwriting profits on a year-to-year basis. So the pooled captive structure is what you see on the screen here. You're purchasing stop loss. The captive is reinsuring above that specific deductible. And then specific reinsurance is supporting any losses above the captive layer. In our pooled environment, the captive layer is a $200,000 captive layer. So again, members join the captive, 60% of their fixed cost is going to be allocated to the captive layer. All the members in the program have access to that captive layer. If there's dollars in this captive layer at the end of the year, those dollars get distributed pro rata across the members of the program. In a risk reward captive, each member's premium, roughly 60%, is going to be allocated to their own member loss fund. If they were to exhaust that loss fund, there's a potential assessment. So they may have to pay a little bit more in before the other members of the program pick up their losses via what we call captive risk sharing. So these three buckets, member loss fund, member assessment, captive risk sharing, make up the risk reward structure. Again, my individual performance and allocation to the loss fund is my upside potential. So if I don't have large claim activity, any of the dollars that are left in my own individual loss fund come back to me at the end of the year via dividend. If I have a challenging year and I exhaust the dollars in my loss fund, that's okay, right? That's what it was there for. But before we allow the other members of the program to pick up your losses, we're going to ask you to pay a little bit more in via a member assessment. And that member assessment is calculated using a percentage of your loss fund allocation. So program to program, that will vary. But in general, this is the risk reward structure in comparison to that pooled model. Okay. So one size does not fit all, right? And so captive resources, as I mentioned, over the course of our tenure, has developed 41 captive programs on the property, casualty, general liability, auto side of the house. And the medical stop loss captives, which were introduced in 2011 to the market, today supports 4 different programs. And depending on your size, how you're funded today, fully insured, self-funded, level funded, do you prefer the pooled approach versus the risk reward approach? We have different programs that we align you with. So our target here, where we're most successful with groups on an alternative funding arrangement, like a group captive, really targets employer groups that have 50 to 1,000 enrolled lives, right? That's where we're most successful and it's most appealing. Again, if I'm open to the pooled approach, we have a captive solution that fits that need. If I prefer the risk reward model, we have several programs that can support that, given your structure today, fully insured versus self-funded. So it's a opportunity for us to really meet you where you are, what your risk tolerance is, and obviously we're not expecting you to have the answers today or even walk away from this presentation thinking, hey, I really like that pooled approach, or I think the risk reward model is better for us. The next step here, if there is interest, is for us to dive a little bit deeper to get a better understanding of how you're positioned today, your size, your structure, and then together with Lewis and team, make a decision on, which program might align best. Key benefits, program flexibility, right? You're still going to have access to premier service providers and partners. So think Aetna, United Healthcare, Highmark, Blue Cross Blue Shield, right? Cigna, all those networks that you might be familiar with today, still going to have access to those. It is member owned and directed / controlled, right? So you're now in the driver's seat relative to how your plans are created, underwriting profits coming back to you, and obviously the control over your healthcare spend is the long-term strategy, right? Obviously, the collaboration and the networking with like-minded businesses is a big part of this too. And what I would add here is, I wouldn't expect you to go through an evaluation process and look at the financial aspect of this in year 1 and say, geez, Lewis, why didn't we do this 5 years ago? This is such a financial win. It could be, right? But it likely might be really close to where you are today from a total spend standpoint. But that's not what the focus should be, right? The focus is more of the long-term strategy, what this is going to do for us in year 2, 3, 4, and 5 and beyond. So keep that in mind too, as you think about what this can really do for the organization long-term. So to summarize here a little bit, why captives, right? We've kind of hit on these things throughout today's presentation. Return of unused loss funds, right? Investment income is an owner of a reinsurance company, right? You now have access to that. You have access to control over your insurance program. We talked about, the opportunity to decide on your plan designs and how you want your benefit program to look and feel to your employees. We also talked about insulating you from market conditions. And again, more focus for you all at the end of the day on risk control and claims management, right? And that's a big part of the captive. When you get the control and the transparency, you've got to be willing to engage and partner with a consultant like Minor Benefits Group, because they're the ones that are going to help you and be the stewards of that strategy, right? And it's a big focus on risk control and claims management. Why are long-term costs lower, right? So Scott, this all sounds great, but how the heck can this remain, or can you continue to lower long-term cost? Obviously, it's going to be based on your individual loss experience, right? So you're not handcuffed or being dictated to by the insurance carrier. You're honestly protected from the market conditions. So hard and soft markets aren't going to impact you. You're insulating yourself from carrier bias, right? The reality is your operating costs are much lower in a self-funded captive environment than what they would be in the traditional market. And we show you what those operating costs are. So again, another area of transparency that gets overlooked. Enhanced loss control and claims management, as we talked about. And then when you think about unused loss funds and the investment income from our conversation, those dollars are significant. And they may be significant over a 3-year period. But again, because this is a long-term strategy, that equity continues to build and build over the tenure of your captive life cycle. So what's an ideal group captive client? This first bullet here is a pretty big one. And I don't know if the audience is kind of a mix of senior management folks or HR vice presidents or directors. But obviously, when we think about group captives, we're talking about an alternative funding arrangement. And alternative funding arrangement means a different way of financing your healthcare. So if you're interested in this, and if it makes sense to engage with Lewis and his team, you've got to have the right people at the table. And so there is definitely an appetite for senior management to be committed to impacting their healthcare spend and engaging with different strategies from a cost containment perspective to accomplish that. From a premium perspective, anything between 200,000 and 2 million is typically the sweet spot for us. Obviously, there's caveats to that for every group. And this may not mean anything to you all, but it means something to Lewis and I, and we'll navigate that conversation when we need to. But again, a willingness to collaborate with other members. Those of you who are just frustrated with the traditional market, tired of that fully insured, hamster wheel, jumping from one carrier to the next every couple of years. And obviously, at the end of the day, it's going to be for employer groups that are in a financially strong position, right? There is some cash flow differences between this model versus the model that you're in today. Although at the end of the day, we can make it look and feel almost identical to the flow of dollars that takes place today. The difference is some of those dollars are staying with you to support claims exposures in the future. And the other portion of it's going to support your fixed cost responsibilities. Okay, so we've got 6 minutes left. And Lewis, I guess turn it back to you. If you want to add any comments or if there's questions in the chat box, we can certainly address them.
There are 2 questions.
Yep. And then I have one, Stephanie, after you ask these 2.
Okay. The first question is, could you give an estimate of initial costs?
Initial cost, I think they're probably referring to capitalization cost to join or become an owner. The most simple component of it is is an actual stock purchase. So there's 2 shares of stock that are purchased. That preferred share that I spoke to before, which is how dividends come back or underwriting profits come back. And then there's a common share, which is your voting right in the program. On the healthcare side, the stock purchase is a flat $20,000. So whether I have 1,000 employees enrolled or I have 50 enrolled employees, the stock purchase will always be a flat $20,000. Now, that is not a sunk cost, right? It still remains as an asset on the balance sheet. And that 20,000, as I mentioned in the front of our presentation, would be invested in our captive investors fund. It's a conservative mutual fund environment, but has 8 billion in assets today. So over the last 30 years that investment fund has existed, we've returned back to employers roughly 6% on average year to year. There is also a collateral function that is part of the capitalization cost. That can be supported with cash, or it could be supported with what we call a bank letter of credit. So no cash has to be coming out of pocket to support collateral. But what's unique to us and why a lot of members choose to utilize cash for collateral is because those dollars, once again, are not sunk. They're assets on the balance sheet, and they will earn investment income year to year. To give you an idea of what that collateral cost is, it's typically a percentage of your stop loss premium. So depending on what that stop loss premium is, the collateral would be aligned with a percentage of that dollar amount.
Thank you, Scott. One other question is, how is qualified risk determined?
Really good question. So one of the things that is very true of our captives, and if I could speak to it a little bit more on the front end, we introduced our stop loss captives in 2011. We've had 99% retention across all of our captive programs since inception. So very sticky. We're not losing members. It works, right? When you think about the risk profile and what we're doing on the front end to underwrite and validate if employer groups are eligible to come into the program, it's something that we as consultants take seriously. And certainly we've identified a risk profile that we kind of manage our fronting carriers to, right? Our stop loss partners. So to put that in more context, if I'm fully insured, I'm typically looking for fully insured groups that have had renewals under 20% over the last 2 to 3 years. That's usually an indication that the group is running relatively well and that there's no large claim exposures. In addition to that, we're utilizing AI underwriting tools for fully insured groups when we don't have claims data to identify any potential risk like large claim exposure over 100,000, specialty drug utilization, cancer diagnosis, so that we can validate if the risk is good risk to come into the program, number one, but two, that we're not setting up our potential member for failure, right? So there are some years which we might say, this isn't good risk. We can't, invite you into the captive. Here's why, right? And if I'm self-funded, the risk profile is really for those groups that are operating below 100% loss ratio and have limited to no large claim activity. It does not mean that if you have 5 high cost claimants that were one and done scenarios that you're not a fit, right? The concern on self-funded groups with data is the projected ongoing high cost claim activity. What does that look like, right? So that's part of the evaluation. But to say it, this is more of a country club-like environment, right? Not everybody's going to get invited. It's got to meet the risk profile. And if it does, then it's a pretty significant solution for employer groups.
Scott, a couple of the folks on the call are in a consortium. And maybe in part the cost question is in comparing the cost of what they might be currently paying in the consortium versus this version of partial self-funding. Can you just review quickly the difference between a consortium model and the captive model, and why the captive model might be a better choice in some cases?
Yeah, sure. And I would argue that for those of you who are in a consortium model, it likely made sense, right, to engage in that model at some point. But now that you're in that model, you probably have access to claims data, and you have some transparency into what's going on with your group. So in a consortium environment, and I'll kind of broadly state this, and it may be different depending on the consortium you're in, but overall, you're paying at max cost, right? You see your specific stop loss premium, your aggregate premium, and you see your aggregate factors, and you're paying those costs up front. So you're fully funding it. And if you perform better than expected, there's typically a surplus that would come back to you at the end of the year, right? And you get to the end of the year and you've got 50,000 or 100,000 in surplus, you kind of feel good about that, right? In a self-funded environment via the captive, we are still identifying the same type of cost share strategy, but you're realizing your surplus in real time, right? Because in a captive environment, you're only paying your fixed cost and your administrative costs on a month-to-month basis. The claims funding is just set aside into an operating account underneath your roof, so it never leaves the employer. As claims are incurred, we're dipping into that claims account to fund those dollars, but the reality is at the end of the year, if you run well, you've retained your surplus throughout the year. It never left your bank account. In addition to that, especially if you're in that risk reward program, which a lot of consortium employer groups move into, they have the history, they have the data, so they can see how they would have performed over the last 2, 3, 4, 5 years in a risk reward model. So in addition to the surplus that would have been realized in the consortium environment, we're giving them access to additional underwriting profits and investment income. So their performance relative to large claimants gives them the opportunity to earn back, right, 60%, up to 60% of their fixed cost, which they otherwise would have never seen come back. Does that help?
Yes, and would you say that in general, the initial capital outlay, the 20,000, and the buying those shares, that is generally offset by overall lower initial costs, but also ongoing better utilization and maybe return with dividends and those things. So that captive outlay in the beginning may or may not be actually an additional cost in the short term and the long term.
Yeah, I mean, to your point, it's not a sunk cost, but to your point, any type of savings that would be identified on the front end from a fixed cost perspective, and certainly within the first few years, the underwriting profit outcome or dividend outcome of the performance of the group will certainly outweigh any of that upfront cost. If I'm being fully transparent, for groups that are engaging in these conversations and evaluating this, it's very rare that somebody would walk away and say, geez, this looks really good, but we're not comfortable with a $20,000 stock purchase, right? If it's public sector environment, this is likely not something that they have an appetite for. But for most privately held or private equity backed organizations, $20,000 stock purchase and a small collateral amount up front is not deterring them from moving forward with this solution.
Okay, great. Thank you. I would just add in general, as Scott said, this is not for everybody. And this is a very deep conversation, and we've had a lot of detail here, but there would be more detail to share. So we would hope that if you had additional interest, that we could have a separate conversation that's more specific to your organization with Scott, and the team, the benefits teams here at Weiner would be glad to set up that time to find out even in more detail if this is the right thing for you and if it makes sense for you moving forward. Usually when we're dealing with these kinds of conversations, it's too close to renewal. So we should start this conversation, what, Scott, at least 6 months or more before or a quarter before renewal, just so we can get the lay of
Yeah.
the land and an understanding of whether this is actually something to consider. What's your thoughts on that?
Yeah, I agree 100%. 6 months before the effective date is typically when we would encourage the initial conversation to occur. Obviously, it's maybe fresh on your minds after hearing and seeing what we talked about today. So diving a bit deeper into the specific program that might be the right fit for you is the first step. We can also run some feasibility analysis. Whether you're fully insured or self-funded today, we can actually run it through our predictive indicator tools to validate what it might look like for you and if it is going to make sense financially. So you can have that peace of mind that, hey, maybe it is worthwhile to add this into our conversation and explore it. But we can absolutely do that. The sooner we do it, the better, because to Lewis's point, this decision is a long-term decision and likely something that you want to be very comfortable with well in advance of pulling the trigger on it. And so the more runway we have, the better to validate all that and make sure you have all your questions answered.
All right, great. I think we don't have any other further questions. If I know we're over time here, and thank you everybody for your patience. Stephanie, Mike, benefits team, James, Wendy, anybody else have questions before we jump here?
I do not. I really appreciate your time today, Scott. And again, for those of you who stayed on, thank you. I know we went over, and we will have this recording up in the next day or two. It just takes a few days to get onto the website.
Awesome. Well, I appreciate the time today, everybody. Lewis, Stephanie, Wendy, James, Mike, thank you for the opportunity to present today. And if there's any questions or anything that we can do to help conversations in the future, don't hesitate to reach out.
Thank you. Fantastic.
Thank you,
Have a great
Scott.
day.
Thanks, everybody.
Bye, everyone.
Bye.